In the world of stock market investing, two of the most well-known and time-tested strategies are growth investing and value investing. Each approach appeals to different types of investors based on their financial goals, risk tolerance, time horizon, and investment philosophy. Growth investing focuses on companies expected to grow significantly faster than the market, often trading at higher price multiples. Value investing, on the other hand, centers around finding undervalued stocks, those that trade below their intrinsic worth, often considered to be on sale. Though both methods aim to generate long-term returns, they differ dramatically in how opportunities are identified, how risk is assessed, and how portfolios are built. Below are the top 10 major differences between growth investing and value investing to help you determine which strategy aligns with your financial goals. 1. Investment philosophy. Growth investing is based on the idea of capitalizing on a company's future potential. Investors who follow this strategy seek out firms they believe will experience rapid earnings or revenue growth. These companies may not yet be profitable, but they show significant promise through innovation, market disruption, or expansion into new territories. In contrast, value investing is grounded in the belief that the market often overreacts to news, leading to stock prices that don't accurately reflect a company's true worth. Value investors hunt for bargains, choosing companies that are fundamentally strong but trading below their intrinsic value due to temporary setbacks or market pessimism. 2. Financial metrics used. The metrics used in evaluating stocks vary significantly between the two strategies. Growth investors tend to prioritize metrics like earnings per share, EPS, growth, revenue growth, return on equity, ROE, and forward-looking indicators such as market expansion or user growth. Value investors, however, focus on metrics that indicate a stock is undervalued, such as the price-to-earnings (P/E) ratio, price-to-book (P/B) ratio, dividend yield, and free cash flow. While growth investors are more concerned with where the company is going, value investors are focused on where the company stands now in relation to its price. 3. Risk tolerance. Growth investing typically comes with higher volatility and greater risk, especially in the short term. Because growth stocks often trade at high multiples and are priced based on optimistic projections, they can suffer significant losses if those projections aren't met. These stocks are also more susceptible to changes in interest rates or economic downturns. Value investing, by contrast, is considered a more conservative approach. By purchasing stocks that are already priced lower relative to their fundamentals, value investors have a built-in margin of safety, making them less vulnerable to market fluctuations. 4. Time horizon. Both growth and value investing are generally long-term strategies, but the expected payoff timeline can vary. Growth investors might be looking to hold stocks for 3 to 5 years or longer, especially if they believe in a company's long-term potential to dominate its sector. Value investors, however, often need even more patience. It may take years for the market to recognize a company's true value and adjust its price accordingly. In some cases, value plays out slowly as companies return to profitability or as broader economic conditions improve. 5. Market conditions. Market conditions play a crucial role in determining which strategy outperforms. Growth investing tends to thrive in bull markets or during periods of low interest rates and strong economic optimism. Investors are more willing to pay premium prices for future potential when they have confidence in the economy. Value investing, on the other hand, tends to outperform during market corrections, recessions, or when investors become more risk-averse. These periods highlight the resilience of undervalued companies and often lead to a re-rating of their stock prices. 6. Company types targeted. Growth investors typically target companies in emerging or rapidly expanding industries such as technology, biotech, and green energy. These companies reinvest profits into research and development rather than paying dividends. Value investors are more likely to invest in mature, established businesses in sectors like finance, consumer goods, or energy. These companies often have solid balance sheets, consistent dividends, and long track records, but may be temporarily overlooked due to poor recent performance or negative news sentiment. 7. Dividend consideration. Dividends are often a key differentiator between the two strategies. Value investors usually seek companies that pay regular and reliable dividends, viewing them as a sign of financial health and shareholder-friendly management. Dividends also provide a steady income stream and reduce the reliance on stock price appreciation alone. Growth investors, in contrast, are not focused on dividends. In fact, many growth companies do not pay them at all. Instead, these firms reinvest all profits into expansion efforts, which is where growth investors see their returns coming from. 8. Portfolio volatility. Growth portfolios are typically more volatile, as they often contain stocks with higher beta values, meaning they react more sharply to market movements. This increased volatility can lead to substantial gains, but also steep losses. Value portfolios tend to be more stable due to the inclusion of lower beta stocks that move less aggressively with the broader market. This reduced volatility can provide peace of mind during economic downturns or turbulent markets, making value investing appealing for more conservative investors. 9. Historical performance trends. Over different decades, growth and value strategies have taken turns outperforming one another. For example, growth stocks dominated in the 2010s due to the tech boom and low interest rates, while value stocks outperformed in the early 2000s and during post-recession recoveries. These performance trends are cyclical and influenced by macroeconomic factors, interest rates, and investor sentiment. Savvy investors sometimes blend both strategies or shift allocations based on where they believe the economy is headed. 10. Iconic investors and role models. Famous investors are often associated with either growth or value philosophies. Warren Buffett, the most notable value investor, made his fortune identifying companies with strong fundamentals that were undervalued by the market. He focuses on long-term ownership and intrinsic value. Growth investing champions include Peter Lynch and Cathie Wood, who believe in identifying fast-growing companies with the potential to reshape industries. Understanding the strategies used by these icons can offer valuable insights into which approach might resonate with your own investment style. Growth investing and value investing are both credible, historically effective methods of building wealth in the stock market, but they cater to very different investor profiles. Growth investing appeals to those willing to embrace volatility and risk in exchange for the chance at above-average returns through innovation and market expansion. Value investing, on the other hand, attracts more cautious investors who seek stability, income, and long-term appreciation by buying good companies at discounted prices. Neither strategy is inherently better than the other. It all comes down to your financial goals, risk tolerance, and belief about how the market values companies over time. In many cases, a balanced portfolio that incorporates both growth and value elements can offer the best of both worlds, cushioning risk while capturing opportunity.